Like to welcome you all to the Daily Energy Markets podcast. It's Monday morning, February the 26th, more than halfway through the first quarter. But I just thought we'd put up that question that we had last week. We put it to our viewers, which showed the opinion on what will happen for the rest of this first quarter. And most there are saying it'll plateau and 10% saying it'll fall. So let's get a view today from our two guests, Omar Najia, Global Head Derivatives BB Energy, and Vandana Hari, Founder and CEO of Vanda Insights. Great to have you both with us today. Omar, let me start with you on that sort of oil price direction. Narrowing it down to the second half of the first quarter is a very narrow window of time, but oil prices have continued to sort of weaken. Is this just short term? Do you think you've been quite bullish about where we're going? But how much, how high could we go in the first half of this year, let's say, given the demand concerns?
Okay, so since I have a graph up, since the 11th of December, prices hit a low on WTI of 67.74, and we're now trading at 76 something. So I don't think they've actually gone down. I think they've actually gone up, right? So 11th of December, low 67.74. The high was on the 29th of Jan, which was about 79.20 something, maybe 79.60. So the market's going up. So our view is we are bullish. I think this market's going to go higher. So basically, if you look at the last couple of weeks, last week and the week before, we went and almost set new highs. The next week, last week, we did set a little bit of a high and then we came off. And we'll see what happens this week. Today, I mean, this week is IP week, so a lot of people are out. I'd expect, I mean, it's a great time to kind of surprise people. It's usually the physical traders who are at IP week because they need to speak to counterparts, whereas people like me don't have any counterparts. We just have the market. So I think I'm bullish. I'm still looking higher for a great many reasons, including but not limited to geopolitics, OPEC plus, the exogenous markets, the US dollar, inflation, etc., etc. So our view is that we're headed higher. This market is a buy. You want to buy it here, great. You want to buy on if it dips more, great. Would we sell here strategically? The answer is absolutely not.
Okay, all right. Thanks, Omar. Vandana, let's go to you and talk a bit about the factors that could be behind this, this sort of steady rise, if you like Omar said, in the first few weeks of this year. But perhaps less of a rise than some people were expecting, given the geopolitics, given the uncertainties that we're having around. So it looks to me like the demand factor is weighing on those, on that bullish sentiment. What's your feeling on how much higher we could go in the first half of this year, and what are the indicators that can put us into that trend, basically?
Hi, Diala. So I think in the short to medium term, I feel the market, and within that, by that I mean in terms of crude price direction, will be hyper focused on events in Gaza. Of course, we've seen over the past 2 weeks a lot of waxing and waning of the hope that there will be a ceasefire deal between Israel and the Hamas militants. And the latest on that front, including events up to the weekend, through the weekend, I feel have sent mixed signals to the market. Now, just to remind ourselves, crude futures closed down by 2.5% to 3% lower on Friday. And that, to my mind, was the market factoring in increasing hope or expectations, whatever you want to call it, that there will be a ceasefire deal. Of course, we've seen a renewed push in the talks last week. I also feel, Diala, that the approach of Ramadan, which is likely to start on the 10th of March, it has narrowed the window. It is putting a little more pressure. It does put a little more pressure, extra pressure on Israel to at least agree. We all know this is going to be a temporary truce, right? They're talking about 6 weeks, but because given the humanitarian crisis and worsening crisis in Gaza, I think if that continues through the Ramadan month, it's just natural that could spark off greater tensions, perhaps more attacks, especially by Iran and its proxy militia. So I feel the next few weeks, it's going to depend on whether or not a ceasefire deal is sealed. I feel currently about perhaps $4 or $5 of risk premium on account of the Middle East crisis. If we do see a ceasefire deal, and of course, again, that doesn't mean peace. That only means peace for a very short time. But nonetheless, I think markets are quite short-sighted. So I feel we could see a complete evaporation of the remaining risk premium, taking Brent back to perhaps closer to 75.
Okay.
That's quite a contrasting point of view.
Yeah. And I mean, that risk premium has been stuck, hasn't it, really, in that $3 to $5 since the beginning of tensions and the activities in the Middle East, and doesn't seem to be shifting. We did have the Houthis still in action over the weekend or just before the weekend, targeting another US, I think, flagship this time. But again, that doesn't seem to be pushing prices up this morning. And there you go, geopolitical risk premium, what people are factoring at the moment. Omar, let's talk a bit about, and we'll come back to geopolitics again and fundamentals as well. But I wanted to talk about gas a bit this morning because, we've seen nat gas prices in the US at least, and I know there's different types of gas prices across the globe, but being termed as almost at all-time lows, and that's at a time when we don't have a lot of new supply coming on the next year or two. So it's looking very oversupplied there. And where do you see the trajectory for that in the coming few months, not just the next week or two?
So if you pull up the most traded natural gas prices, which have the deepest liquidity, et cetera, are called Henry Hub. They trade in the US. Mm-hmm. So if you pull up a chart of Henry Hub prices, you will see that plus or minus, they are at historic lows, right? So again, you could look and say, supply and, everybody in China and make up stuff and say, the moon tomorrow is going to be full and all this kind of stuff. And my friend is buying all this stuff. But the bottom line is either nat gas prices have bottomed. Okay. And by bottomed, yes, they could move sideways for a while. But what's your risk reward here?
How much lower can they go? Yeah.
But seriously, I mean, it beggars belief. And you see these people and it's just, and it's an indication of what it's an indication of is when nat gas prices start to rise, you're going to have masses of people who are selling out of fear, because they're thinking, how much further can it go? And so basically they come and they start to sell because, they have a position to protect or whatever it is. When it starts going the other way, they're going to be watching and getting like deeper and deeper out of the money. Then they're going to kind of panic and it moves up. The other thing I wanted to say about, the Gaza thing, the impact you're looking for is not on crude, right? Israel gets supplied with crude through Turkmenistan, Turkey, Iraq, Syria, Turkey into Israel. What Israel gets supplied with is basically distillates through the Red Sea. And those ships exploding are basically, putting increasing freight costs, putting pressure on that side. So if you look at basically, so that's why I think, I like gas really against crude. But I think that's where the impact is. I don't think you should look at, crude prices going up and down because of stuff to do with Gaza or the Red Sea or anything like that, right? I mean, you need to see an escalation to see a risk premium come in. If you see an escalation with Hezbollah, then, maybe people will start to buy. But to think that basically, you buy crude here because there's any risk to supply anywhere, I don't see it. Because what's the problem with the markets right now is the Red Sea. It's got nothing to do with anything else. So I don't see that risk premium. If you have a thing with Hezbollah, then you can say, okay, maybe Hezbollah and then Iran and all this kind of stuff. So I really doubt people are buying crude because they fear an escalation in the Middle East, because I don't see what the impact is apart from distillates and freight costs.
Yeah, of course. And if we have a full-blown escalation, that's something else. But we haven't touched on that yet. Thanks, Omar. We'll come back and talk a bit about gas. Wanda, let's talk about China a bit and demand and the outlook there. We haven't heard from you in a couple of months on sort of what the mood is in Asia for Chinese demand and perhaps other demand as well as we move through the year. Clearly we have a new normal of lower growth, but China's chugging along nicely. You've got two schools of thought. Some say it's going to continue to be a big supporter of this market. Others say it's kind of going to get worse. What's the sentiment there in Asia at the moment?
I think China and sort of contrasting expectations with regard to how China would come out of how well it would rebound once it had ended its strict lockdowns. The biggest volatility and sort of divergence in viewpoints happened and played out through last year. And that it's important to keep that in mind, because we started 2023 with a lot of people saying it's going to be a fantastic, phenomenal rebound, and factoring in upwards of 1 million barrels per day, perhaps even up to 1.5 million barrels per day year-on-year rise, rebound in Chinese demand growth. And as the year progressed, through the middle of the year, they were already revisiting those sort of bullish expectations. And by the end of the year, the picture and the sentiment had changed completely. So as we go into 2024, I think it's a little bit better in the sense that that divergence and those question marks, or just being unsure about how it'll play out in China, there's a little more certainty on that account. I think expectations are much more moderate and tempered now. So this year, of course, I think Chinese oil demand will continue to grow. I would say perhaps more like 400 to 500,000 barrels per day year-on-year growth. What we are seeing and hearing from on the ground in China is that consumer sentiment has weakened considerably. And as we know, in China, the consumer sentiment is quite closely linked to what is happening in the real estate market and the property market. And though there have been some steps by the government, and recently a benchmark rate that governs mortgage rates was dropped by the biggest 25 basis points, the biggest drop ever. But even that left a lot of China watchers, economists, analysts saying that Beijing remains, just too little, too late mode. So the sentiment from the ground is, yes, people have spent. I think most of that spending has happened through 2023. I think 2024, we're going to see consumers tighten their purse strings. And of course, again, let's keep in mind that in China, it's not just gasoline. So yes, will people be driving more, flying more? Yes. So gasoline and jet, yes. But the bigger chunk of consumption in China is diesel. And diesel being used, of course, in the manufacturing sector, but also very closely linked to what's happening in the property sector, movement of raw materials, but then also consumption of white goods and what have you, as people buy houses and move into new properties. So all in, I think I have a very sort of cautious, moderate view to what Chinese demand growth will look like this year. I think Indian demand growth has been quite strong last year. Almost 5% year-on-year growth in fuel demand. That could continue, perhaps not 5%, a little bit lower. But in India, there's simply a lot of spending happening on infrastructure. I expect the Modi government to come back after this year's elections, in which case we can expect more of the same, continued spending on infrastructure. And just generally, I think the economy is doing well. The government pegs the economic growth at around 7%. So, generally it's a much more feel-good factor amongst the consumers, and, so India will continue to grow.
Okay, thanks, Vandana. Omar, just to pick a bit on the China thing and the products. Jet fuel, of course, got a bit of a boost ahead of the Chinese New Year. people travel, but more domestically perhaps. But again, jet demand, that return of that leftover jet demand that's still to return from pre-COVID, which is expected out of China for domestic travel or international. Are we still expecting that to come forth this year? What's the or do we see that demand coming from elsewhere in Europe or the US, lending support to jet?
I mean, to be honest, I'm not sure, but all I can tell you is that when I get on a plane, they're all full. So I don't know if we're expecting, I mean, I don't know, but I think every place that I've been to has had like loads of tourists, planes are full, airports are full. When I drop people off, same. So I don't know if it's going to be there's going to be more demand or whatever. All I know is that markets are healthy, economies are healthy, people are spending. You're looking for the Fed to cut rates, which basically means that people will spend more. We're not looking for anything to do with a recession, which is quite impossible with the US running a $2 trillion deficit. So you add that, and you think surprises will be to the upside and not to the downside. So in general, we like the markets, we like the economy, and we like prices. We think that they will go higher. And it's almost impossible to kind of, see what jet demand fuel is. And it depends on who you ask and how they find it and all this kind of stuff. It's not an exact science. So, I tend to ignore it.
You mentioned interest rates. Yes, we're expecting a drop in US Fed rates, a fraction perhaps in June at the June meeting, most people are saying, and then perhaps another one. But the cuts are a bit less now at this time of the year than were being expected, let's say, a couple of months ago. That's kind of, has that dampened, do you think, the mood at all for the projections for the US economy? And I know what the stock market is doing, but on the ground, in terms of other real companies that are operating, I mean, do we see any nervousness there that we might see a slight slowdown this year?
No, I think basically if you look at the probability of cuts, there was thinking that it was 90% that they would cut in March. Now that probability is down to 3%.
Yeah.
But again, I mean, people can confuse themselves as much as they want. They can say, it's 3% now, it was 90%. And the forwards basically March, April, May, June, et cetera, all tending down in terms of probabilities. But that's not what's important. What's important is they get to cut rates. Doesn't matter if they cut like 0.25 today. It's the same with demand. Doesn't matter if you talk about 0.375 or 0.276, whatever it is. Doesn't matter. What matters is the trajectory. What matters basically is they're going to cut rates, which means higher prices. What matters is demand is going to go up, which means higher prices. Now, you can argue all you want and say, well, not as much as they expect and all that kind of stuff. But that really doesn't matter. The market has a life of its own. Once money starts coming in and people start to buy and prices start to rise, they don't care about 0.273 and 3.254. They just don't care. So the trajectory is higher.
Vandana, let's talk a bit about OPEC. They're due to meet again quite soon, and a lot of focus on them, on what they're going to do about these extending the cuts that the extra voluntary cuts, if you like, that are due to finish at the end of March. Some people saying they'll definitely go into April by extending those. Others are saying it's a done deal. They have to go to June given market conditions. What do you think is in their thinking and what they're factoring in? They've been kind of pretty good at managing things by all intents and purposes from a price point of view.
Well, there was definitely a strong OPEC put in the market, I would say, between April and roughly September or October of last year. To my mind, that OPEC put has disappeared. Now, what do they do? Just again, of course, we're talking about Q2. We know that their additional cuts of about 900,000 barrels per day are due to expire on the 31st of March. Now, they do need to make a decision sometime before the 10th of April, because typically by the 10th is when the Middle Eastern nations need to give the allocations for their term lifters. of crude. And if they're going to adjust those their targets, then of course they need to accordingly tell their customers. Again, just to remind ourselves, there is no formal meeting of OPEC plus ministers planned until June. So that has left the market doing quite a bit of guesswork. It is very unusual. A lot of unusual things have happened. I mean, starting with, of course, the tensions we saw erupt within the organization at the end of last November, but also unusual in that OPEC Plus has gone from declaring its cuts or targets for a year in advance to just 1 quarter. And the most direct impact of that has been the market starting to increasingly doubt that there is the same degree of cohesion, the meeting of minds that one saw within OPEC over the second and third quarters of last year. So with
of course,
no,
I mean, just to cut in there, I mean, of course, the June meeting, one of the big things to be discussed, and it may be discussed obviously as a preamble, is the quotas and the change of those for the permanent cuts. But Vandana, if you could just also address Russia's involvement at the moment in OPEC plus. And I mean, we last year we talked a lot about Russia, OPEC plus, and is it not complying? I feel that OPEC, the other members, and perhaps Saudi as a leader, is kind of just putting that aside now. They're not even thinking about Russia. And we've just seen new sanctions put on it by the US as well. Are we factoring them in anymore? Do they matter?
Yeah, so just to round up your first point, which was, what do we expect? I think when we say what is the market expecting, I think it's slightly different from what do analysts or market watchers think OPEC Plus ought to do if it wants to avoid a downward spiral in prices. So the answer to the latter is that at the very least, yes, they should roll over, which will again mean that these are the voluntary cuts. Another reason the market has sort of discounted the strong cohesion that used to exist in OPEC Plus. As far as so again, going to your point about June, I think it remains to be seen whether at the June meeting they actually take the bull by the horns and address the point of should they now go back to the convention, which was like set a target for the entire group and then apportion it equitably between all the members, which will mean countries like Nigeria. Of course, Angola is no longer in the group, but especially Nigeria, I believe, is not very keen on cutting back even more. These countries have suffered from low production and much below target production for a couple of years. As far as Russia is concerned, I think the intent is there in Moscow. I think they know that they can't continue because they have promised to be more transparent, and this was something that unfolded since after last November's meeting. They have promised to share more data, so they can't be being transparent and cheat. So I think the incentive is there, the pressure is there on Moscow to comply. I think what is also happening, and one should keep that in mind, is that Russian crude is facing a lot of hurdles. So some of the drop in Russian crude exports would be voluntary and as according to Russian pledges, but I think some is also facing hurdles because of this US tightening of the $60 per barrel price cap. We've seen in recent weeks, for instance, that Indian refiners are starting to face quite a few hurdles in getting Russian crude because, over on Friday, we saw the US sanctioned Sovcomflot, the biggest Russian shipping company, and 14 tankers in which they have interest. So, like it or not, Russia is also going to somehow have to curtail, unfortunately, its crude, cut that out. Because
Omar,
of the shipping problem.
Yeah, Omar, just to talk about OPEC a little bit with you, do you think, the bullish trend that we're going to see in prices, in oil prices and everything else, does that depend from an oil point of view that OPEC does stick to at least the cuts that it's made? Do you think that's absolutely necessary that they roll those over, the voluntary cuts, and keep those in place till June and beyond?
Well, yes. I'm assuming that they will. I'm assuming that basically they're rational and they want to, maximize oil revenue. So yes, wholeheartedly. It's the same. I mean, you don't. It's funny. You get asked these questions about OPEC and OPEC Plus. Nobody comes and says, do you think the Fed is going to shoot itself in the foot? Is it possible that they shoot itself in the foot? Really, is it? But is it? So at the end of the day, you have to make some basic assumptions, like the sun's going to rise tomorrow. It's possible that it doesn't, but it's low probability. You have to assume that OPEC is going to do what's best for OPEC. Is it possible that they don't? Yes, but it's low probability. So yes, I assume that OPEC.
Yeah, but also their policy of supporting prices is helping non-OPEC production, isn't it? And that's kind of they're beginning to face now, in the US and others who can take advantage. Does that matter?
No, I've been hearing about, I've been hearing about shale for like, I don't know how many years now, 5 years, 4 years. Shale is dead. Let me explain shale. Shale it's a very simple thing. They need a lot of money. It's very cash intensive, massively cash intensive, and the depletion is basically exponential, right? So when interest rates are 0, you could do shale. When interest rates are 5%, there's a lot of better businesses than shale. You can forget about shale. You can forget about alternative, whatever. Who's going to come and invest? I mean, the problem with the oil market is nobody's investing in future supply. Why? Because everybody says that, oil is finished and carbon, I don't know what, blah, blah, blah. There is no alternative to OPEC. It's that simple. None. Zero. Absolutely none.
They're always going to
be the renewables.
Not even renewables. Richard was earlier on the chat talking about that. Let's look at the survey question for today, which is about gas again, looping back to gas. The only way is up from here for natural gas prices in general. Agree or disagree? And we'll just have a look at that a bit later. Baden, I mean, just talking about gas again, we did have this, there's not a lot of investment happening in new oil supply, but Qatar made an announcement, it's on our bulletin today, that it's going to be boosting its gas supply, despite the current, obviously, the pricing that we're seeing in the market that perhaps doesn't matter so much to Qatar. But that's kind of interesting. Is it just trying to maintain its weight, if you like, with the other big producers, or why make that announcement now, do you think?
Well, they found more gas reserves, and either they say that these are going to become stranded reserves, or they say, no, we are going to convert them into additional LNG and export this LNG because we believe the gas demand globally and in Asia is going to continue to rise. I see it as quite a logical and wise move on the part of Qatar. Now, as they've mentioned quite rightly, that Europe's gas demand is going to continue, even if it doesn't rise like the kind of growth we see in demand in Asia. It will remain higher because for the foreseeable future, Europe is not expected to turn back to Russian pipeline gas. And I would believe, aside from Europe, Qatar is looking very, very keenly at Asia. Now, Qatar Energy, so if you just look at the last year, they signed a 27-year term supply deal with CNPC in China. They signed with Sinopec in China, both for 4 million metric tons per year, substantially long-term deals with substantial volumes. Earlier this month, they announced renewal of an existing deal with Petronet in India, which is for 7.5 million metric tons per year. That is a 21-year deal. So Qatar is seeing quite a bit of demand in Asia. And then the other key logic as far as Asian gas demand is concerned is, we know by and large it's quite price sensitive, even including in
particularly
China,
the Southern Asian countries.
Yeah, well, I mean, put Japan and Korea aside, and really those markets are not what producers are targeting anymore, because long term they are plateauing or declining. So it's countries like China, India, Southeast Asia. Philippines has become a new importer. Hong Kong has become a new importer last year. So the idea is that if prices go down because of supply boom in the coming years, and as we know, there's a major wave of supply expected, even if the US projects that are currently being held up because of Biden suspending approvals, export approvals, even if you put those aside, US is adding a lot of capacity as well. So the thinking in Asia and in general amongst producers of LNG is, if prices go down, the price sensitive demand in Asia, which is pretty much the whole region, will flourish. So there will be quite a bit of demand for LNG in the coming demand growth for LNG in the coming years. So it makes complete sense.
Okay, thanks, Vandana. Omar, I'll just go to you to wrap up for us on. I wanted to get your views on the dollar and where we're at with that. That there's the survey result. Agree, the only way is up. Okay, 67%. US dollar seems to have sort of plateaued a bit the last few weeks, if I'm correct. I know it's obviously moving on the hour, but again, you know, and you're pretty positive about all the, you know, seeing that interest rates are going down in the US. Where do we see the dollar going this year? Have we seen it stabilize, if you like, the end of its rise?
No. So if you look at, if you want to look at the dollar, look at a graph that goes back 15 years, right? So you've seen the dollar strengthen against the pound and the euro, and those set lows of, I think, like, I can't remember now, like 103 against the sterling, and maybe like 95, 98 against the euro. And basically they've now reversed. So you took 12, 13 years to get to those highs in the dollar. You're going to take, you know, years, I don't know how many, 3, 4, whatever, to at least correct, if not start a new trend to the upside. So over time, I think basically that GBP will get to 2 to the dollar. In other words, 1 GBP makes $2, and I think the euro will go to 145, something like that, 150. So I think the US dollar is weak. If you want to look at a rational, not a rational, but an explanation in English, you can see basically that the world reserve currency is losing its status. Doesn't happen overnight, but it's definitely happening. The reason is that it's being debased. Why is that? It's because they keep printing money. So the US deficit used to be, you know, whatever it was pre-COVID, 300 billion a year. Now it's like 2 trillion and growing. All they can do, and all the voters are going to vote for, basically more spending. More spending means more printing. US debt is at 34 trillion, so that's just going to grow and grow and grow. So the dollar is going to have to weaken, and other people basically see it. The Chinese are selling their treasuries. The Saudis are selling their treasuries. The Russians have already sold all their treasuries. The UAE is following. So yes, you can. I see the US dollar weakening big time over time. So yes, I'm not at all friendly to the USD. Long term, not for now. And Bitcoin might come in there as well. Thank you so much, Omar Najia and Vandana Hari, for joining us this morning. We missed Jose Shalhoub. I hope to see him next time. And have a great week, everyone.
Thank you.
All the best.
Thank you very much. Take care. Thank you.
Bye. Bye.
Bye.